Hi, I'm Chris Sugden, managing partner at Edison Partners and your host of Electrifying Growth. This is Sit Down with Sugden, where I share from my experiences as both the investor and an operator to help you get that next stage of growth.
Welcome to another edition of Sit Down with Sugden. I'm Chris Sugden, as you know, managing partner at Edison Partners, and a topic that's come up a lot, and it seems like maybe it's this AI gold rush and financing rush, but everybody seems to be talking about PE these days, whether you're an HVAC owner of a company and you're getting knocks on your door to be part of a roll-up strategy, you're a plumbing supply business, or as you know what Edison does, you're running a tech business, a software business, and it's time to consider a transaction. PE is everywhere and it's become institutionalized. And sort of a common question or a common, I even say fear, sitting at my daughter's swim meet, someone owns a business. They say, "You're in PE, right? What's it going to be like working for PE? Am I going to lose my job? What am I going to run into that I could lose my job? Should I expect to be told you're moving on? Do I cash out? Do I roll some equity?" All those things, quite frankly, I'm amazed at how it's coming up more and more. And maybe that's just the nature of PEs all around us. It's almost ubiquitous the way AI is. One of the things we think a lot about at Edison is we back intentionally founder CEOs. Our intention is not to go sort of push a founder aside and drop people in, kind of parachute a professional managerial class CEO in. Part of that's the stage at which we invest, i.e., for those who don't know the Edison Partners investing sort of strategy, right around $20 million in revenue and positive EBITDA, 1 to 5 million of EBITDA is where we generally invest. That's a stage that the founder very much still can be not only impactful, but a really positive force and influence in the business. And at the same time, there are others in our business, in the PE business, the growth equity business, that the model is very different. Okay, founder, you're going to step aside. You're going to step into a CTO technology role. You're going to step into a strategy role. Lots of different ways that PE firms go about this. So let me talk about from sort of my / the Edison playbook, but also sort of my thoughts after doing this for 20 plus years and sort of seeing what works. Number one, our data tells us at Edison, literally we've been around since 1986. So there's over 200 deals. Founders over-index when they get it right. You all have seen that. Elon Musk, Steve Jobs. When founders can actually get to scale and kind of get beyond the velocity to escape, get out to orbit above the earth, they way overperform. And as founders, you have the blessing and the curse of that opportunity because many people want to be the next Jobs or the next Musk or the next Bill Gates, but that's the exception, right? Not the rule. And what PE firms are looking for is, how do I make this thing work all the time? Replicable, repeatable, a playbook. And because there's probably 10%, 15% of CEOs who actually can get to scale. And that's based on our data. Maybe it's a little higher. And I say that when I say get to scale, for us, if we invested 20 million and now we get north of 100 million or headed to 200 million of revenue, the percentage of founders who actually see that journey all the way through and just keep on going, it's a small number. But that's not because we're sort of pushing people aside. It's because the skills that got you from 0 to 20 and then 20 to 100 are different. And how are you able to kind of navigate that changes needed in your own style as a founder, as an entrepreneur, as a risk taker? The sort of classic one is I got to do everything. I'm a founder that wears all the hats because that's what it took to start the business, and I can't delegate. Another common is, can you get beyond, as we like to think about it, kind of generation 1 or 1.0 version of your executive team? Because you probably didn't really hire executives for $100 million business when you were 5 or 10 million. And in fact, did you hire executives at all? Did you hire a bunch of people that kind of learned the ropes? So it's really hard to say, it's time to reevaluate your talent as you go from each stage of growth. I don't like the letter game, the alphabet soup of fundraising of VC, PE, Series A, Series B, Series C. I don't think there are Series B VPs of sales or CROs. I don't think there are Series C of those. I just don't. I think there are those who have run sales or run marketing or run tech or run development that have seen scale, and those who like operating at a smaller level. And you must be intentional about, is it time to now upgrade, if you will, or up level the talent in those seats to allow me to be a better CEO, me being the founder. So kind of thinking about, let's stay on the small end. You're a $5 million, $10 million business, and you're getting that knock on the door from a PE firm. What are the things that are going to be yellow flags or red flags for them to want to keep you in the seat. And then what also are you interested in terms of what you want to do with your life? Because let's face it, you may just be happy that someone's offering you X multiple of revenue, Y multiple of EBITDA to buy your business, and that makes you happy. So let's actually start with, what do you want to do? What are your goals? Because in some ways it is a pain in the neck to run a company. See your baby, it's your baby, but seeing it scale, it's exciting, but it takes a heck of a lot of work. And maybe it's taking you 5 years, 10 years to actually get to scale where someone's taking a real interest in your business and it's time for you to cash out. So start with, what do I want to do for the next 5 years? And you hate to say, I say 5 years because that's the journey. Generally, it's 3 to 5 years that PE firms are kind of thinking about. And it's not just a whole period of 5 years I have to sell. It's a whole period of 5 years or even 3 years. I got to do another transaction. Maybe it's an investment that allows people to take additional money off the table. Maybe it's an acquisition. You're going to get a lot bigger. But you've got to take this in 3 to 5 year increments. And of course, every year is a different year. Every planning cycle is a different planning cycle. So take my 3 to 5 years. But my point is, if you're going to raise your hand and say to a PE firm, I'm your guy or I'm your gal to run this business post our transaction, if you're not really signed up to that 3 to 5 year journey, that is no longer just as an entrepreneur controlling, making all the decisions. I now have a board. I now have a partner. And that partner is a control investor. I now have a boss. Right. So there is to be careful what you wish for if you're going to do a transaction with a PE firm where you sell over 50%. I hate to use the word boss because it almost sounds too hierarchical, but you went from calling all the shots because you own your business to having a partner that's, frankly, rightly so, does control the business from a cap table perspective, from an ownership perspective, but they don't control it from a run the business perspective. I think that's also a bit of a fallacy. If you think about what the PE model is, I like to say, if we're running the business or having to be making decisions that are like running the business, something's gone wrong. So if you think about that mindset, it's actually kind of exciting to have a PE partner come in that knows how to scale, knows what it takes, has seen this movie many, many times, a movie you may not have seen ever or have seen once. You now have a partner, and whether you call them an owner or a boss, that depends on the relationship you strike, but you do have someone who can help you and legitimately can help you be successful. The common pitfalls I see are I have all the answers. I just need your money. And it's not even need your money as in growth capital. I want your money to take it and put it in my bank account or pay off the mortgage or pay for the kids' college education or what have you. I want to keep running my business. Life definitely changes. It in some ways goes from I'm changing the world, I'm growing a business. And I say changing the world, not from a double bottom line perspective, not from a charitable perspective, just from I'm going to go invent a product, create a company, et cetera. My view is, you've gone from that to a very commercial endeavor, as in we're here to make money. Think about our business model, the Edison Partners model, the ABC PE firms model. We have third-party capital, firemen's, teachers, pension plans, insurance companies, balance sheet. Their job is to both protect their retirees' capital or their company's capital and grow it. And they've got to take a really both fiduciary responsibility to that, hence boards and all that kind of thing. But second, it's got to become, I'm going to make 2x, 3x, 5x my money in this investment. So you have to be comfortable that you've moved from a mission driven to a commercial driven. And I don't mean to say your mission doesn't stay important. And I don't mean to say you're not going to have values and a value statement that's really core to you. What I'm really saying is there are going to be decisions that have to be made that are more commercial or more finance oriented than all the decisions you probably made to the point where you're getting the opportunity to do a deal. So start with, why am I doing the deal? Do I need expertise and I'd like to put money in my pocket, or I really want to put money in my pocket and the expertise is secondary? Because frankly, on the latter, my goal is to put money in my pocket, i.e. optimize my value of my business and maximize my liquidity event. That doesn't sound like a CEO wants to scale the business to me. The CEO says it would be nice to put 5, 10, 15 million bucks, pay off the house. I've got children who aren't in college yet. Make sure that's put away, have a little bit of savings. So I put my blood, sweat, and tears in this business, but I actually would like to roll a lot of equity. I actually believe in what we're doing. I've gotten it to 10 million or 15 million or 20 million of revenue. I've gotten it to 3 million or 5 million of EBITDA, but I can 5X the revenue. I can 10X the EBITDA from here. That's what I want to do. So I want to put a little bit of dough, call it like insurance money, in the bank to pay for those kind of big bills. But my big win, my big financial win, my big wealth creation win is the second bite of the apple, as we like to call it. Those are two very different goals that you as an entrepreneur have to answer. And I would say when you answer that and how you answer that would also be your indication of, am I signing up to go keep growing the business, or am I signing up to maybe step aside, step into a board role? Because I still have a role, ROLL, in the company. I still own the business, but my ROLE role is going to be different than CEO. So if you think about what am I optimizing for? Valuation or value in my pocket? Because it's not always the same one. Why do I say that? Sometimes you can actually get a higher valuation, which doesn't totally make sense from a financial markets perspective, by rolling more, because the PE firm's going, boy, this founder or these group of founders really believe in the business. So it takes a little bit less cash going out of the business, and they're sort of assigning up to be partners together to grow the company. So I'll kind of circle all the way back. Am I going to lose my job just because a PE firm shows up? Not if you're one of those 10 percenters. And I say that because we love to find them. Edison loves to back founders who can scale because they tend to overperform. PE firms don't want to invest in the 10%. They want to invest in the 70, 80, 90%, as in this is going to work because we've seen this movie before and we're going to run a playbook. So those are at odds, right? So all the things you do in your courtship of the PE firm, of the firm you're going to end up kind of selling your business to, are all tells along the way of, are you someone that seems, again, commercial in your orientation for decision-making? Or do you sound or seem like someone who's letting the passion and the mission kind of be the answer to all things? Not always to say those don't exist. Believe me, the passion, the mission-driven nature, of course. But I can't raise prices because I don't believe in raising prices. That's not very rational. And a PE playbook is, one of the things we can do is do a price increase. You're probably not undercharging your customers. So think about questions like that. There's a very commercial answer. Either your customers will tolerate a price increase because there's a lack of the elasticity of your customers' pricing tolerance should be tested. Maybe we should say it that way. And if you say, well, no, I would never do that because I have a principle of never raising price on my customers, that doesn't sound like a very commercial answer. So think about questions like that as you think about, am I going to more likely than not lose my job? And are you really ready for a transaction that says, I want to remain CEO and sell control of my company? Based on that answer alone could be a good tell. In other words, I'm happy putting as much money as I can in my pocket and letting that PE firm kind of run the business with their hired managerial class CEO. No, I really see 20 million getting to 100. I make very rational decisions anyway. I've already upgraded a couple of executive level people. I'm ready to kind of have some help upgrading others, finding more talent. One of the questions that constantly comes up as well is, so if you invest in my company and I sell you control or I sell you a big minority stake, are you going to bring customers? And I tie that to the CEO question because it's a little bit irrational to think we're all walking around with just a roster full of customers that are waiting to buy your product. Yes, our job is to add value. Yes, adding value comes in the form of customers or partners or ways to connect with, ways to make your business more valuable. But don't start there. Start with, do you help with talent? That doesn't mean you have a recruiter on staff, Mr. or Mrs. P firm. That means you help with helping me find the right people. You have a cadre of people you know. You're going to ask me all the right questions to make sure I've got the right profile I'm hiring. So just to kind of sum it up, start with what is my goal? I have a dream to run a $100 million, $200 million, $1 billion company. And I not only a dream, but I have a practical reality that I think I can do that. So every way you think about that, every answer you get from a PE firm, from a growth equity firm, should be a very rational, reasonable, and I use the word commercial answer to those questions. If most of your questions are, I've never done it that way and I don't believe in doing it that way, that sounds less rational. Because it is belief that got you to go start the business. It got belief that got you your first customer. It's all the grit and grind of being an entrepreneur. But now you're getting to scale. And belief, just like hope, isn't really a strategy, right? So think about PE firms tend to be very rational, if you will, when it comes down to how do I just drive equity value? As we think about, we're doing due diligence, we're getting to know each other. And quite frankly, to me, it's a two-way street. You as the founder, you might find only one firm has an interest in your business, but hopefully you have many. So you have choices too. So due diligence should be a two-way street. But let me focus on what we might see as yellow and or red flags in interacting with a CEO that we go, that person just can't be CEO going forward. They can stay in the business, or even be better that they're not even in the business. They sort of leave the business, or they go in a board only role. All those things are possibilities. And, there's no specific point A to point B to point C. It's not like a cookbook. It's not a recipe or a specific playbook for this, but there are tells along the way. I gave one example before that's kind of simple, but really practical. There are principles you believe in because you started the business that you would never do something to your customer like raise prices. Well, that's not rational, because if you're trying to increase enterprise value, you're trying to drive revenue growth, raising prices is a very natural thing to do. At the same time, you may just have a belief, I'm never raising price for my customer. Well, that's a bit of a tell to a PE firm. It isn't so much the raising prices, this is supposed to be rational about decision-making. A yellow flag that can become red pretty quickly is we give some feedback to you as a CEO about your team. One, can you handle it? And two, is your reaction, they're all to be protected? Or is your reaction, oh, you see this movie a bunch of times. You're telling my VP of sales is not going to be a chief revenue officer. Let me understand more about that. Tell me more about why you say that. Tell me more about what you're looking for. That's the answer to that question, or that feedback, not NFW or not, well, how would you know? They know the domain better than everybody else. The other fallacy is it domain expertise or pattern recognition that gets you to scale? Early days, if you don't know your domain, your industry better than everybody else, clearly, including your customer, right? Clearly that's a problem, because you just aren't credible. You're either competing with some bigger company, or you're bringing something completely novel to the market. You've got to know the customer's problem better than anybody else. But over time, that importance of what it takes to scale, that importance of domain expertise versus, I'll call it functional expertise, changes. Do I know how to scale a sales organization? Where's the red flag in that? Call it just sort of a doctrine of industry knowledge trumps everything. I've been in that conversation before. I can't possibly hire a CRO that doesn't come from this industry. They'll never understand it. Wait, you as a founder have been living in this industry for a decade, building this business. Don't you have enough to go around? What if we hire a salesperson who comes from your industry tangentially? What if we hire someone who's sold your business model only, but doesn't know your domain? What's the better trade-off? And again, there's no exact answer on what that profile is you're going to hire, but there's a way to answer that question about what's important as you start to think about scale. And if you're starting to answer the question of, we'll call it, again, less rational and adding more commercial, if our goal is to be 10x our current size, you've got to be much more commercial in that sort of thinking. And or the feedback that create yellow going to red flags are the ones that it's a little bit like dogma, doctrine. I just believe, and I can't possibly do this another way. Those are the things that yellow becomes red really quickly. And quite frankly, if you're a founder and entrepreneur out there, you probably had this discussion with yourself and you've answered it sometimes with well, that's how we've always done it. That's also not a great answer. And it sounds a little bit elementary. It sounds a little bit like these ABCs of private equity to some degree, but I've backed multi-time CEOs, multi-time entrepreneurs, and sometimes those people are the worst at it because they know how to get it from 0 to 5, 0 to 10, 0 to 20 over and over again, but they haven't gone 20 to 100, right? So again, know what you're good at. Self-awareness isn't always the top characteristic for entrepreneurs because they've got to almost have they have to suspend disbelief to start a business, right? You all have to. If I'm speaking to you as entrepreneurs out there, if you don't suspend belief and you don't realize, if you're unwilling to take no for an answer, that's a little bit irrational. So almost exactly what got you to a point of being able to launch your company is what can become your worst enemy as you get to scale. And I think so hopefully that's some red and yellow / what could become red flags is you think about this conversation, advancing with a PE firm from, is it time to do a deal or not? But I would say red flags turn into deals dying quickly if the red flags aren't sort of mitigated with, well, that CEO is willing to do this deal and step aside, or that CEO is willing to do a deal and hire a couple of executives around them that have kind of seen this movie before, seen scale before. Those kind of, do you quickly mitigate You have a strong belief in your industry, must buy this way or must be sold to this way. Okay. How do you mitigate that from sounding literally, like I said, dogma or doctrine but here's how I would think about that to test that thesis or hypothesis at scale. But let me just conclude with, again, it's this really interesting, call it a dilemma. There's probably other words, but it's truly what got you here is unlikely to get you there being scale. And do you have the flexibility to know and be aware of that? And do you know what's going to happen along the way? Those people who helped you get to 5, 10, 15, 20 million of revenue, that they may be pushed down the organization. They may have to leave the organization because it's probably going to take some top grading. And one of the most famous people for this, and it's a little dated now, but Larry Ellison at Oracle was kind of famous for every year you get rid of 10%. It sounds just, in some ways really draconian, but I got to get rid of my bottom 10% of performers because they're getting in the way of everybody else. And there's plenty of studies out there like that, but some of that is healthy, right? The old cliche of addition by subtraction, that it is true. What got you here, 10, 15, 20, 30 million of revenue, 50 million of revenue is unlikely to get you there. Are you able to see that and understand that? The biggest tell in all this is, have you brought talent around you that aren't your co-founders? And are you able to hire, for lack of a better way to put it, better than you at the function you're hiring? Because if you're the best at everything, that's also another kind of closer to red flag. So that's kind of how I'd leave it. You look around your management team, look around the group that's kind of driving the business with you, and say to yourself, am I better than all of these people at the jobs that I've hired them to do? There's probably an answer in there that says, I better upgrade one or two of them, or maybe I'm not the person to take this to 100 or 200 or 300 million bucks, because you'll be your own worst enemy. Again, what got you to be successful probably doesn't let you get to escape velocity.
Thank you for joining this episode of Electrifying Growth. For more resources, inspiration, and a look inside the Edison Partners network, sign up for our newsletter at www.edisonpartners.com. Click on the Stay in the Know button in the top right corner of our webpage. Thank you again.